Caterpillar ticker CAT is currently trading at $224.92 and is up by about 32% since the last 6 months. Now, I actually bought this company back in 2022, and since then, the value of my investment has skyrocketed by almost 56%. Now, there's also the expectation that the value of CAT is still on the rise due to the Chinese-US trade conflict, which has been going on since 2018. If we have a look here, we can see that the company has been on a steady rise for the past few months. But if we have a look at the last month, we can see that the company fell by about 6%, and therefore I want to see if today might be the best time to buy Caterpillar at a discounted price. To do this, we'll jump over to my stock evaluation spreadsheets where we will have a look at the 9-pillar analysis and find the intrinsic value of CAT using the Grams formula revised, discounting cash flow analysis model, multiples valuation model, and the dividend discount model. Now, if you look back at statistics, we can see that the current dividend yield of CAT is at 2.23%, which is really decent for a dividend growth company. You can also see that the cash per share is at $1.20 per share per quarter. Now, the analysts currently project the target price of $250 by the end of this year, which is quite high to the current price. To the left here, we can see the income statement and the cash flow statement, which for the most time have been increasing fairly decently as well. Now let's jump to our 9-pillar analysis and see how this company is doing internally. First, we want the 5-year P ratio to be below 22.5, and CAT passes this P ratio with a P ratio of 18.24. Next, we want the 5-year profit margin to be above 10%. CAT is currently not passing this profit margin with a profit margin slightly below 10% of only 9.92%. Now, Caterpillar has actually been increasing their profit margin over the last few years, which is something I really like, and I really think that in the next few years, the profit margin will certainly be above 10%. Next one, the revenue and net income growth over the last 5 years to be positive. We can see that both revenue and net income growth have been indeed growing, and by quite a bit actually, so that's great as well. Next, we want there to be a decrease in shares outstanding. Now, we have to be careful, as even though there is a decrease in shares outstanding, I do not believe that Caterpillar should currently be buying back shares, as it's trading at a really high price compared to its historical value. I believe that they should wait until the stock price drops further, and that's when they should start buying back shares. So even though this is a tick, we should take into consideration that this isn't actually ideal. Nevertheless, let's move to the next pillar, which is the long-term liabilities over the 5-year free cash flow to be lower than 5. This is currently sitting at 1.28, which is fairly decent, so that's a tick as well. Next, we want there to be an increase in free cash flow over the last 5 years, which has been happening as well, and it has been increasing by almost 8% over the last 5 years annually, which is great. Now, the price to free cash flow isn't lower than 20, but it's near. Similarly to the 5-year profit margin, I believe that it will grow in the next few years to be lower than 20, so that's a great thing actually. Finally, we want there to be consecutive dividend growth, and as we can see, this metric has been growing really well by almost 10%, which is really rare to see when evaluating a dividend company. Now we can move to finding the intrinsic value. First, we're going to apply the Grams formula revised. Here we're going to plug in the earnings per share of the company, which has been growing over the last 2 years and is currently at its highest point. Next, we're going to plug in the base PE and the 5-year earnings growth estimate. We're going to multiply that by the growth rate multiplier, and using the average yield of AA Corp bonds and the current yield on AA Corp bonds, we're going to get an intrinsic value of $324, which is currently about 50% higher than the current trading price, which would indeed be a buy if you were to only look at the Grams valuation. But in this channel, we'll look at 4 different valuation methods to make sure that the intrinsic value we find is actually the intrinsic value of that company. Now let's move to the discounted cash flow analysis model. Here I plugged in the free cash flow over the last 10 years and calculated the average growth rate, which as you can see is pretty low. But if we look at the last 5 years, we can see that the average growth rate is certainly not only 0.34%. That's why when combined with the analyst growth rate projections, I calculated a growth rate of about 5.48%. I then used this calculated growth rate to project the future free cash flow over the next 10 years, and using the discounted rate, I calculated the present value of the future free cash flow. I then summed up all this future free cash flow and added any cash and cash equivalents, subtracted total debt, and got an equity value of $53 billion, which I divided by the shares outstanding and got an intrinsic value of $103, which is really lower than the current trading price. Now let's move to the multiples valuation model. Here I compare Caterpillar to CMI, PCAR, and WAB. I took their current stock prices and divided by their current earnings per shares to get their price per earnings. I averaged out those price per earnings and multiplied by the earnings per share of Caterpillar to get an intrinsic value of $255.72, which is about $20 higher than the current trading price. Now, for those of you who don't know, multiples valuation is based on comparing the company we are evaluating to companies that operate in a similar field and have a similar structure to the company we are evaluating. Now we can move to the dividend discount model. Here I plugged in the values of quarterly dividend payouts for the last 5 years and multiplied by 4 to get the yearly dividend. I took the growth rate and calculated an average growth rate of 9%. I used this growth rate to calculate the next year's dividend, and using this and the WACC, I calculated an intrinsic value of $253.92. Again, quite higher than the current trading price. Now we can move to the final valuation, where we average out the gross valuation, multiples valuation, discounted cash flow valuation, and the DDM valuation to get an ultimate intrinsic value of $234.34, which is currently 5% higher than the current trading price. Now let's say I still want to apply a margin of safety of about 10%, which would give me an acceptable price of $211. Now if we look back here, we can see that over the last year, Caterpillar has certainly hit points where it has been trading at the intrinsic value we have calculated or below even. Now before we finish, let's have a quick look at what the analysts project for Caterpillar for the next few years. We can see that earnings per share should be growing steadily for the next few years, and in 2027 should be at about 19.76. Now for the net income before tax, we can see that that should grow as well, and by the end of 2025 should be at 11.52 billion. Now if we scroll further down, we can see that the analysts also project a growth rate for the dividends per share. We can see that by the end of 2027, the analysts project a yearly dividend to be at $5.6 per share per year. Now finally, if we scroll all the way down, we can see that the analysts do project growth in revenue as well. If you enjoyed the video, make sure to like it, and if you really enjoyed the video, make sure to subscribe to the channel if you want to see more videos like this. Also make sure to let me know down in the comments which stock you would like me to evaluate next. If you want to watch more of my videos, they're on the screen here right now.